Hey everyone, welcome back to Corporate Dakota. Today, N.E.X.M just filed their quarterly report for March 2026, and I am seeing some concerning trends in their cash position. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is heavily reliant on funding and their cash burn is significant. Alright, let's dive into the numbers for NexMetals Mining Corp or N.E.X.M. Their latest quarterly report for the period ending the 31st of March 2026 is out, and it paints a picture of a company heavily dependent on external funding to keep the lights on and the drills running. Looking at the balance sheet, as of the 31st of March 2026, total assets stood at about $81 million. This is down from nearly $98.5 million at the end of December 2025, suggesting they have been spending cash rather than acquiring new assets. On the other side of the ledger, total liabilities are around $9.4 million, which is a decrease from about $15.6 million at the end of 2025. This is good news to see liabilities coming down. Now, shareholders' equity is where things get really interesting. As of the 31st of March 2026, shareholders' equity is about $71.7 million. This looks positive, but remember, it is made up of preferred shares additional paid in capital minus a deficit, which is basically accumulated losses, and this deficit is substantial, standing at over $216 million. That deficit alone is a big number, and it shows the company has been operating at a loss for a long time. They also have an accumulated other comprehensive loss of over $4.3 million related to foreign currency translations. Now let's talk about cash is king. And right now, N.E.X.M's cash position is shrinking fast. As of the 31st of March 2026, they had about $26.2 million in cash and cash equivalents, down from over $39.7 million at the end of 2025. This is a significant drop of about $13.5 million. And why is the cash dwindling? Well, the company reported a net loss of over $10.6 million for just the first 3 months of 2026. That is a massive burn rate, especially when you compare it to the $15.2 million loss in the same period last year. This loss directly translates into their cash flow from operations for the first quarter of 2026. They used over $12.2 million in cash just to run the business. This is significantly higher than the nearly $6.3 million used in the same period in 2025. It appears their operating expenses are growing faster than their ability to generate any income. On the investing side, they spent roughly $768,000 on property, plant, and equipment. This is a substantial increase from just $50,000 last year, likely for necessary upgrades or expansion related to their mining operations. The financing activities show a stark contrast. Last year, in the first quarter, they brought in over $45.5 million through financing activities likely related to a private placement. But this year, they actually used about $266,000 in financing activities, meaning they did not raise substantial new capital during this quarter to offset their operating and investing costs. This big jump in financing last year came from proceeds from issuing units, which is a way for companies to raise money by selling shares and warrants the absence of a similar financing event. This quarter is a key concern. Let's look at what they are spending all this money on. Exploration and evaluation assets are their main game. These assets, the ones that are key to their future mining projects, are valued at about $41.4 million as of March 2026. This is a slight decrease from $42.7 million at the end of 2025. A significant chunk of these exploration costs relates to the Celebi Mines acquisition. They made a big payment of over $34 million for the second installment of the Celebi asset purchase agreement, indicating substantial ongoing investment in these mining assets. Even though they paid this large amount, the company is still very much in the exploration and evaluation stage, with no current revenue from these mines. The bottom line is that NexMetals is burning through cash at an alarming rate. While they have significant exploration assets, they are not yet generating revenue to cover their costs. The net loss for the first quarter of 2026 at over $10.6 million is a clear indicator of this financial strain. And this leads to a critical point. Management itself acknowledges the substantial doubt about the company's ability to continue as a going concern. This means there is a real question about whether the company can survive in its current form without significant new funding. It is not uncommon for exploration stage companies to face these challenges, but the scale of the losses and the shrinking cash balance are not able. With only about $26.2 million left in the bank and a burn rate of over $12 million per quarter just for operations, they have a limited runway before they need to raise more money if they can't secure additional financing on favorable terms. It could put the company in a very difficult position. The risk I am watching is their ability to raise the substantial additional funds needed to continue development beyond their current estimated funding horizon. Their past financings were successful, but there is no guarantee future attempts will be the same. Especially with a growing deficit and ongoing losses, the company appears to be in a race against time to find more capital before it runs out the research tools I actually use are. Linked in the description, they help keep this channel going. Alright, that is my Take Stay Decoded.